Hi, everybody. It's Peter Schiff. It is Sunday evening, September 2nd, 2012. Although by the time I upload this video, it will be Tuesday, September 4th. I want to start by talking about Ben Bernanke's much anticipated Jackson Hole speech that we got on Friday. And once again, the Fed chairman widened the crack in the QE3 door. Of course, I believe that he swung the door wide open a long time ago. In fact, I think he's inside the QE3 room. The problem is a lot of people have been slow to come to that conclusion, although more and more people are beginning to see the light. Of course, the Fed chairman himself has been very coy with respect to QE3. He doesn't want to really show his hand. He doesn't want to come right out and say that we're going to get QE3 for sure, because he wants to maintain the pretense that it's possible for the economy to recover without QE3, and that only if needed will he come to the aid. Of course, I've said many times that the phony recovery that resulted from QE1 and QE2 cannot be sustained without QE3, and so QE3 is inevitable, as is QE4. We're going to keep on getting QE until the economy finally implodes. Of course, in laying the foundation for QE3, in his speech, Ben Bernanke went on to pat himself on the back and praise the Federal Reserve for its prior efforts and how QEs 2 and 1 helped the economy, and how the economy would be much worse had the Fed not come to its aid. Now, I guess you can say the Fed helped the economy the same way that you would say giving heroin to a drug addict helps the addict. Sure, it helps them avoid withdrawal, but if you really want to help a heroin addict, you don't give them more drugs. You advise them or help them check into rehab. You do an intervention, and you actually encourage them to go through the short-term pain that would be necessary to get all the drugs out of their system, so they no longer depend on it, and ultimately you would protect them from dying of a drug overdose. The Fed is not being nearly as responsible, so it's simply claiming credit, even though the pain that the Fed averted was ultimately constructive pain. It is the pain that we would have needed to produce real growth, lasting, genuine economic growth. See, what the Fed still doesn't understand, or if it does understand, it's certainly not going to admit this. The economy in the United States is screwed up because all of our resources are misallocated. The misallocations are a response to the Fed, to the Fed keeping interest rates artificially low and encouraging economic activity that, absent that cheap money, would not have taken place. And because of the false economic signals sent by artificially low interest rates, the factors of production, our resources, land, labor, and capital, are misallocated. They're not where they should be. They're where the Fed directed them. Now, the free market doesn't like that, and market forces are always trying to restore equilibrium. So the free market is trying to put those resources, those factors of production, back in their proper place. What the Fed does with quantitative easing is it resists those forces. Now, the problem is the more QE we have, the more screwed up the economy gets, the stronger the forces the market has to try to bring them back. It's kind of like stretching a rubber band. The further you stress it, the further, the stronger the forces, of course, trying to pull it back together. Of course, you run the risk of breaking it completely, and that's what the Fed might do. But ultimately, the market, if you're going to stop that from breaking, the economy from collapsing, the market is going to ultimately bring forces to bear on the Fed that it is incapable of resisting with QE. Now, in addition to claiming success for prior QE, and of course, I don't see how you can claim it was a success when the economy is still not growing at a pace that the Fed would consider healthy, and that we still have a very high level of unemployment, yet the Fed simply says, without our prior actions, it would have been worse. I agree that it would have been worse initially, but it would be better now. And the pain that we would have felt would have been constructive because it would have been the pain associated with correcting the market's imbalances. Instead, now, the pain we have is a result of preserving and perpetuating those imbalances. And of course, because those imbalances, instead of being addressed, have been widened, the future pain, when we ultimately do the right thing, is that much more agonizing. But in addition to that, the Fed also maintained that QE was the appropriate policy and that any negative side effects maybe of the QE, that they would be minor and that the Fed had the tools at its disposal to utilize them. So in other words, the Fed said there's no damage from QE, and the Fed claimed that QE had worked in the past and that it will work in the future, and that if the economy doesn't start growing more rapidly on its own, the Fed is going to step in with more QE. My question would be, what are they waiting for? If the Fed basically says that QE works and there's no downside, there's nothing that the Fed can't contain, if this really is the magic elixir that's going to cure what ails the economy, why are they withholding it? They're basically dangling this in front of our face saying, we have the cure, but we're not going to give it to you yet. We just want to make sure you're as sick as we think you are before we give it to you. Why not just, give it to us anyway? If there's no downside and you know it works. See, I think the real reason that the Fed is delaying is because they know it won't work. And the sooner we get QE3, the sooner it's going to fail. And now we're going to have to get QE4. So the Fed wants to pretend that it has this magic elixir to cure the economy, but it doesn't want us to swallow it because it knows it won't work. Of course, yes, temporarily it works a little bit if you consider, the phony growth that ultimately collapses to be working. But the problem is, the more QE the Fed does, the less effective each subsequent dose is, and the bigger the dose has to be. So the Fed is reluctant to show, how impotent it really is. So it'd rather talk about how effective QE is going to be than actually implement it, and then the market knows just how ineffective it actually is. Now, eventually, it's going to have to give up. As I said, the market forces that the Fed is fighting off that are trying to rebalance our economy grow stronger and stronger as each subsequent dose of QE just screws up the economy even more. But until the Fed recognizes this and gets out of the way and lets the market, repair what the Fed broke, we're never going to have a lasting recovery, and all we're going to get is endless rounds of quantitative easing until the economy succumbs to an overdose of the stuff, and either we have hyperinflation, which is the worst case scenario, or we have the correction that we badly need, only it's going to be that much more painful because now we have a lot more mistakes that have to be corrected, because in the future we're going to have to correct the mistakes that are going to be made as a result of QE3, as a result of those that were made as a result of QE2 or QE1, or all the mistakes the Fed made during the 1990s that inflated first the stock market bubble and then the real estate bubble that followed. Really what we need to do is correct all these mistakes, but we can't do it because the Fed is still compounding them. Now, the markets, they saw through some of the smoke screen, at least the gold traders. They were quick to react to Ben Bernanke's comments, although the knee-jerk reaction, when the speech first began, gold actually sold off. I think maybe because the Fed didn't lead, or Ben Bernanke didn't come right out and say, I'm doing QE tomorrow morning. He didn't give an exact timetable. The market sold off, but by the time traders got to digest the gist of the speech, which is QE2 is coming, or QE3 is coming, I just don't know exactly when it's going to start, and we don't know the exact form that it's going to take. Is it going to be a set dollar amount like QE2 was, or is it going to be just an open-ended commitment to provide as much QE as it takes to do the trick, which is to get the economy growing and to bring unemployment down, which means it's an open-ended, never-ending QE, because no matter how much QE we get, we're never going to grow the economy, we're never going to create jobs. It's just going to inhibit the process. Again, until we have a real recession, we'll never have a real recovery. And we can't have a real recession unless the Fed stays out of the way and lets it happen. But of course, the political pressure is too great for the Fed to do that, because what they're concerned about is helping to reelect the politicians that are currently in office, and they can't get reelected if we're going through the pain of reallocating resources. You see, in order to get resources back where they need to go, in order to get labor where it has to be, capital where it has to be from where it is, there is a process where you have a dislocation. And that process is painful. People have to lose certain jobs to get other jobs, right? People have to lose money, bad debts have to be liquidated so that new investments can be made. We need to underconsume so that we can build up our savings. Well, if we consume less, that means GDP has to contract initially, as money that was being spent is now being saved. Ultimately, that saved money will be invested, and that's going to grow the economy in a productive way. But we can't get from where we are to where we need to be without some transitionary pain, and that is what the Fed and all the stimulus is designed to prevent. They want to fight off the cure so the disease gets bigger, but they want to numb the pain with stimulus so we don't realize that we're getting sicker. Getting back to the gold market, so after the initial sell-off, we had a pretty sharp rally. Gold finished the day up almost $40 an ounce to a new 6-month high. Silver had a big move on the day. I think it was up about $1.30. Oil was up almost $2 a barrel, which again is one of the other reasons that the Fed is holding off on actually implementing QE3, because it knows the sooner it does it, the sooner you're going to get even bigger spikes in commodity prices, and that is going to be interpreted certainly as a net negative, maybe by the voters in the November election. So rather than send oil and food prices up much higher now, the Fed might be trying to hold off and delay that until maybe later when it won't be as politically problematic. You know, I did an interview earlier today on Al Jazeera, and I was in a kind of a roundtable discussion of food prices and why they're rising. And the host of the show, when asking me a question, said that even though there is no signs anywhere of inflation, that inflation is well contained, food prices are going up anyway. And so why are food prices going up when, you know, there's no inflation? And of course, I had to remind the host that rising food prices were a flashing neon sign of inflation. We know there's inflation. Look at global money supply. Central banks around the world are creating lots of money. That's the inflation. What the host was pointing at was the bond market and saying interest rates are still very low, reflecting an absence of inflation. You have to understand that in the short run, these markets are being manipulated. The reason that interest rates are still so low is because central banks are using all this money to buy up bonds, particularly the Federal Reserve. So inflation is moving into the bond market. It's bidding up bond prices and keeping interest rates down. But the Fed is not able to manipulate food prices the way it's able to manipulate interest rates. So there are signs of inflation if you just know where to look for them. But if you're foolish enough to believe the government and look at the bond market, well, then you might be oblivious and scratching your head as to why other prices are rising so fast when, according to the government or the bond market, there's no inflation. Well, the governments manipulate the CPI statistics, and they manipulate the bond market. There's no free market there. But eventually, the forces of the market will overwhelm the central banks, and you will see a collapse in bond prices and soaring interest rates and more evidence of inflation in the government doctored official consumer price measurements. But of course, by then it's too late. So you got to look at the early signs in money supply and in commodities like energy and like food. Let me move a little bit over to politics. I was at the Republican National Convention all last week down in Tampa, Florida. In fact, I'm heading tomorrow down to Charlotte, North Carolina for the Democrat National Convention. In fact, by the time you're watching this video blog, I will already be down there. If you're looking for any change in policy from the Republicans, should Mitt Romney prevail in November, you're not going to find it. I mean, basically, the Republicans are full steam ahead right over the edge of the actual fiscal cliff, not the phony fiscal cliff. The Republicans are not talking about any spending cuts at all. They did talk in the abstract about smaller government, but they didn't mention one program or one department they would cut or eliminated. In fact, the only government spending cuts they talked about were Medicare cuts, and that's when they accused Obama of wanting to cut Medicare, and they said, elect us, and we'll make sure there are no cuts to Medicare. So the only cuts to government spending that were spoken about specifically are the cuts that the Republicans opposed. So the Republicans want to increase spending on Medicare. They want to increase spending on Social Security. They want to increase spending on national defense. They can't do anything about the increase in spending on interest on the national debt. So 80+% of the budget is still on autopilot or growing. So even if they can come up with some small cut somewhere, it still won't be enough to offset the increases that they support. So the Republicans want bigger deficits. In fact, the national debt clock was running the whole time at the RNC. Of course, nobody really talks about the fact that a lot of those big deficits were run up on Republican watches. Of course, that official debt clock was just below 16 trillion. I think it's actually going to hit and surpass 16 trillion at the Democrat National Convention, which is probably a reason that they're not going to have those debt clocks over at the DNC. But of course, if you think the Republicans are bad on spending, the DNC, the Democrats, are going to be even worse. They want to grow spending even faster than the Republicans. The only difference is they want to raise taxes, marginal income tax rates, which may actually perversely result in even bigger Democrats than even bigger deficits than the Republican plan, because those taxes are going to hit the very sectors of the economy, the job creation, the investment that we need to try to grow the economy. So perversely, even though the Democrats are in favor of more revenue, it's the wrong kind of revenue, and it might actually backfire. So we might even get bigger deficits under the Democrats. In fact, we probably will, because they will grow spending faster than the Republicans. But it's all a question of degree. I mean, are we going to go over the cliff at 100 miles an hour or 90 miles an hour? At the end of the day, it really doesn't make a difference, because we're still going over the cliff, and it's going to be just as big a collapse when we go over it, regardless of which party. So ultimately, the Fed is going to have to continue. It doesn't have to, but it will politically. Will continue to do QE. Will continue to monetize debt. And unfortunately, Ben Bernanke is wrong when he talks about the Fed's ability to contain the damage or to rein in the excesses of the liquidity. It can't do it. Once you let that inflation genie out of her bottle, you can't plug it back up again. But in any event, the Fed is not going to be able to pull this off. It might be able to bluff it, but it can't. And I think that the crisis is going to come relatively soon, whether it's a year, whether it's 2 years. Can we stretch it beyond that? I really hope not, because the longer the Fed is successful in postponing the inevitable, the worse it's going to be. And of course, as it gets worse and worse, the temptation to push it to the nth degree is there. And of course, then you get hyperinflation. You completely destroy the dollar. And that is the worst of all possible outcomes. Hopefully, cooler heads will prevail before it becomes that bad. Ultimately, as I've written in a recent commentary, I think the only thing that's ultimately going to save the system will be a return to the gold standard. Because I think if we do have a currency crisis and confidence is lost in the dollar, I don't see how it's possible to instill confidence once again. I mean, they did it, Volcker did it, and Reagan did it with 20% interest rates. There's no chance that we could do that now. So I think the only thing would be to tie the dollar to something of value like gold. Other countries, when they go through currency crises, the way they get out of it is they tie their currency to the dollar, being the reserve currency, to try to create some stability, to tell creditors in the world that we just can't keep printing money. We have to maintain the relationship between our currency and the dollar. Well, when the dollar is a currency that's imploding, where the loss of confidence is in the dollar, is there a fiat currency that anybody has confidence in that we can peg it to? Are we going to peg the dollar to the euro or the yen? I don't think so. So the only choice we'll have at that point will be to peg it to the dollar. Anyway, remember, I will be doing my video blogs live from the DNC in North Carolina all week. just like I did at the RNC. Make sure and tune in. Again, it's schiffradio.com from 10 a.m. to noon Eastern. It should be more interesting down there. I might get more arguments. Maybe I can get some guests to come on that really want to mix it up with me. I might try to go undercover as a liberal, try to see just how far to the left some of the Democrats are willing to go. I wonder if there's any absurd statement that they would oppose. I mean, is any amount of government too much government? Maybe we'll find out, or maybe I'll be able to relive an Occupy Wall Street, Zuccotti Park kind of moment. There probably will be quite a few protesters down there in North Carolina. So anyway, make sure and check the internet, check my radio show for developments. That's all for now. Take care, everybody.